Wall Street has gotten around on the perspective that Bitcoin is digital gold. It's something that you can comp against gold. There's a generational perspective on it. It is, a store of value in should be viewed as digital gold in a lot of ways. Maybe with the call option potential of becoming like a tech or a monetary platform eventually. Whereas Ethereum is very clearly the place that Wall Street will want to tokenize assets. And as we start to see more post-Genius Act, and as we start to see more what we expect will be with Clarity tokenization efforts, it's all going to be tokenized, and it's very clear that Wall Street wants to tokenize on Ethereum.
Quick shout out to today's sponsor, Katana. We'll hear more about Katana's 1 billion cat campaign later today, but for now, let's get into the episode. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. All right, everyone, welcome back to another Bell Curve Roundup. You got me and Michael. Michael's holding it down. Obligatory joke about chopping the dead weight.
Every time. Always lands.
Yeah. This will be a fun one. So I actually, we didn't even talk about this before the program, but I don't know if you saw GPT-5 came out today.
Yeah.
They did a little live stream.
It is, I haven't had a chance to play around with it yet. I know it came out, I think, like 2.5 hours ago, but exciting times. I think maybe like one perspective of just being here in San Francisco is like people are looking forward to like GPT-5 day as much as like major releases of iPhones used to be. And it's just really interesting to see how AI in the last 3 years has really captivated the consumer appeal with ChatGPT in particular. And it's Rajiv on our team was saying anyone who's used to maybe 4.0 is going to be really pleasantly surprised. Maybe not 3 Pro. He thinks 3.0 reasoning is probably a little bit closer to what 5 is going to enable, but anyone who's been on 4.0 completely is probably going to be pleasantly surprised with the difference. And if every year or so we get another one of these upgrades, you start to wonder, like, it's sort of like that boiling the frog point where it's like, if you slowly boil the water, just like you don't notice the differences at each intermediate step. But if you were to take a step back and say, oh, well, in 2022, when we had the release of ChatGPT 2.0, compare that to 5 now, it's insane.
Yeah.
And, that's happening in, not too distant or not too long of a period of time, yet they're like completely different products.
So I'm showing here the poly market for which company has the best AI model end of 2025. And actually it was interesting to see this as like a gauge of sentiment. So actually based on the poly market for this, the ChatGPT 5 model was a bit of a flop because you had very tight in between Google at 44% and OpenAI at 35%. And then it split to Google to 53% and OpenAI is now around 18 or 20%.
Well, and so I think the reason why is because this is the last release that ChatGPT will have this year.
I didn't realize that. Yeah.
And it's expected that it'll be the last major release. And so this is kind of like the finished product for 2025. And yeah, we'll see what Gemini comes out with. So that might be the reason, but also if you look at, actually it's even more telling if you just look at, there's a market for which model will have the best, will be the best by the end of August. And actually that's an even larger flip. So you had ChatGPT at 76%, and now you've got Google at like 84, 80%, basically. So I don't know. I actually think that, I watched it. I watched the stream. I had like an hour and a half free. I was just like, I'm going to turn this thing on. And what was your takeaway or what?
I thought it was a little underwhelming. Like I watched previous ones. First of all, no offense, I know public speaking is hard, but I didn't think they picked the most, most charismatic people to debut this thing. And it was funny because actually some of this I'm loosely trying to learn Korean at the moment. Fits and starts. But actually, one of the things that it's supposed to help you with, they literally demoed using learning another language, and they did Korean. But I don't know. It just one of the things that was, it seems like the big change is they're making a better model available to free users, and they're also consolidating the model. So you don't need to flip now in between 4.0, 3. It just default, yeah, it all is the same thing. And I guess it sort of, for simple questions, it'll automatically redirect it toward, like, think of it the way I'm thinking of it in my head is like routing, right? And right. I've actually noticed this using ChatGPT. Sometimes I'll ask for like really easy demographic data, and it thinks for like 3 minutes. It's like, I should have just asked the easier model this.
They used the wrong model.
They used the wrong model. So I think they're taking that out of your hands, which is good.
That's great.
But let me, okay, I'm at risk of giving you the ultimate mid-curve theory here. So I'm aware of what I'm about to say, but I will say, so everyone, bubbles don't tend to occur when everyone's calling for bubbles. They occur when no one thinks that it could be a bubble anymore. And I will just say there's been a record amount of like a huge CapEx build out in AI up to this point. And no, I don't hear anyone even questioning whether or not it's a bubble anymore. And this would be, if it were to be that, okay, these models slow down and maybe they're really good, but they get, there's diminishing returns, that would surprise everyone a lot, right? Like we're basically pricing in, exponential growth, super intelligence, trillions of dollars of CapEx per year. That's all being priced in. Like, I don't know. An interesting risk reward here would be that if you were to just say this plays out like every other big, tech CapEx build out where we get a little over our skis and we have to correct and before we keep going out.
But so. you also just Schrodinger's catted the problem in that if you call it a bubble, then it obviously can't be a bubble. So
I'm not sure I have enough Schrodinger authority here. I don't know what they're at. I don't think I can generate enough of the observer effect for that.
Well, I think you're starting to see CapEx build show up in GDP. It's at 1.2%. I think there have been some podcasts on Blockworks about this investment thesis, but it's a very common, even some of our LPs some of our larger LPs were telling us they've been spending a lot of time with their real estate teams focused on data center builds. And even Chamath is coming out saying he's building a gigawatt scale data center in Texas. Like everybody and their mother wants to get into the GPU / data center / power game. Yeah. And it's because people recognize that if we're going to grow at the scale that we expect we will need to grow based off of AI demand, that we're going to put hundreds of billions of dollars, maybe trillions of dollars per year into the ground, and that is just a gargantuan amount. And so I think I hear what you're saying in terms of what if the user experience doesn't live up to basically like the capacity that is being built out. And therefore demand is always below. And people point back to the Cisco example where Cisco was basically the networking layer for the internet. And it had this famous run up in stock valuation, in stock price in 1999, I believe. And then with the blow up of the internet bubble, it dropped 95% plus. But what was really telling about that is Cisco is still a very, very large business, and it has tens of thousands of employees, and it's a large business, but it's never actually gotten back to its peak stock price. Yeah, and that story is something that is etched into the minds of tech investors because they remember, we got way over our skis in terms of what we expected the networking capacity would be required to enable, but I think the main takeaway here is what's different is that was a networking layer, which is at a certain point you have networked all 7.8 billion people on the planet, and we have done that, and there's max supply. But with AI is that there's increasing compute demands over time. And so the increase of just a basic question to a reasoning question is like 10 to 100x because you have a recursive re-asking of more questions, searching for more information. And so the compute demands scale logarithmically. And so that's kind of like why everybody is thinking about this thesis as, oh, maybe this time's different. But to your point, if you don't keep up with demand, and I think ChatGPT has something like 1 billion weekly active users, which is the fastest of any consumer product to get to 1 billion active users. But if that pace doesn't continue, then you have to expect that it's not just the growth of users that is going to be what's filling that demand, but it's going to be the increase in compute that's filling that demand, which means that you don't have any more DeepSeek type moments, or you don't have any more algorithmic improvements that reduce compute requirements for asking these questions. And so, yeah, it's a bet. It's an interesting bet. It's a very common bet right now, though. And I do kind of get the spidey senses tingling when I see basically everybody thinking about things in the exact same way. And one of the examples, there's a very kind of common perspective right now that Bitcoin miners, because they have power hookups, well, they can just become AI data centers. Or like, oh, you've got, like Galaxy, because they owned a bunch of debt from a company that went bankrupt, they now own this data center, and like they're literally building out an AI data center. So like Galaxy, the investment bank of crypto, is becoming an AI data center operator. Like everybody is doing this. And so, yeah, it does feel a little weird. I don't know if we can say the B word yet, though.
I don't know either. I'm just like, look, also I know my lane. AI is not my lane. I have no idea, right? But I will say, if it were to be the case, right, it's always kind of, I guess the observation that I would make is you rarely hear anyone call this the B word, right? And that's generally, and it would be like the most classic, mini bubble of all time, right? Down to like massive CapEx build, get out over your skis. I mean, even something like, what if we got drastically more, even as like a small example of something that's kind of interesting. So a lot of the way that you're measuring build out here is like the amount of tokens, right, that gets consumed, like computational power. And ChatGPT has effectively done like smart order routing here, right, through different models, which should actually reduce the amount of tokens and computational resources that you need. Whatever. I know Ryan Connor, our head of research, actually knows his shit way more than I do. I'm sure he's gonna He's gonna at me at this.
This episode is sponsored by Katana. Katana is a DeFi-first chain built for deep liquidity and real yield by redirecting chain revenue back to active DeFi users. The 1 billion KAT campaign is live. Bridge and deposit directly into vaults in one simple click and start earning immediately on your Ether, Bitcoin, USDC, and more. Follow the link in today's show notes to get started. We're entering crypto's cloud era, and EigenLayer just launched EigenCloud to power it. Just like AWS transformed the internet, EigenCloud is a full developer platform that gives developers cloud-grade programmability with crypto-grade verifiability on any chain. To learn more about how the Eigen token is securing a new class of verifiable apps and how to get exposure to this growing class of crypto infrastructure, follow them on X at EigenLayer. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
But another subject that we are totally the experts in, macro.
Yeah.
I'm seeing it here in the chat that Trump has officially appointed Stephen Miran as Fed governor, replacing Kugler. So we have a change at the Fed, and to be expected. Kugler resigned, but it's Stephen Miran. Interesting.
Did you see? By the way, shout out Felix Forward Guidance, who got him on to the Forward Guidance podcast like 9 months ago, which is pretty nuts. Did you see that this guy? I think his name is James Fishback. Okay, do you remember a little while ago, Dan Loeb got into an argument with someone who worked at Third Point about being head of macro, and there was this whole "you're not head of macro," and he was like, "No, I am. I was the macro guy," and he gave himself this title. Do you see he's making a little bit of headway towards trying to put his name in the ring for replacing Powell? Have you seen this? Yeah.
What is he, like 5th on the poly market chart?
I don't know where he's at. Yeah, let's actually check where he's at on the poly market. But Yeah, and also we had so there was a massive downwards revision in new jobs being created. So erased something in the zip code of 250,000 jobs over the course of the last 3 months, and Trump fired the head of the BLS who is responsible for that, which is probably somewhat of a controversial decision. But there's definitely a big shakeup that's happening, right, in some of these more bureaucratic kind of sclerotic institutions. And, if I was really bullish, I'd say, yeah, get some of these people out of here. They're not doing a great job, obviously. If I was to take the other side, I'd be like, ooh, are these the best people to be putting in some of these roles? And it doesn't look great when you're firing the head of your, the economic data. That's a little, Banana Republic-esque. I don't know.
You ever seen the video of Matt Damon doing his Tom Cruise impersonation about stuntmen?
No.
Stuntmen. Well, Matt Damon does this impression of he's like talking as if he's Tom Cruise, and he's talking about the stunt that he's about to do, and he's so super excited, and he's like talking to his stunt coordinator and the safety expert, and he goes, yeah, so and then I'm gonna do the stunt myself, and the safety coordinator goes, well, no, you can't do that, and he goes, okay, yeah, right. And Matt Damon goes, well, what'd you do next? He goes, well, I got a new safety coordinator. It's like, okay, all right, that number. All right, who's up next?
Yeah. You know what that also reminds me of is, Milei, when he took, when he gained power in Argentina, and he's like, they're going to throw 200 useless economists at me, which is, what I will say, this is an interesting period of time to live through where, yeah, like everyone with economics or like macroeconomics 101 is like, these tariffs suck. And, to which I would say, maybe. I have no idea. These things haven't been tried in a long period of time. We're really digressing into macro now, but yeah, I guess we're going to experiment with a lot of stuff and see how it all shakes out. But.
Look, we've had surpluses or closer to surpluses each month since tariffs started, more so than we have in decades. That I think has been positive, more positive than we would have expected. As well, the inflation expectations seem to be pretty tempered in terms of what the effect of this would be. And going back to what you said about Friday with the jobs report, the revisions actually kind of give credit now to a September rates cut, which Tamarinos, whatever his name is, from the Wall Street Journal, who's sort of like the eye on or like the finger on the pulse of Powell. He basically says now he's got the mandate now to maintain independence and be able to cut rates in September. And so that percentage chance of a rate cut after Friday jumped from, I think, 35% to 85%. So the expectation is we're basically going to have a rate cut in September, and we're going to get a couple more prints of both inflation and jobs before then. And I think if we continue to see sort of a upward trajectory in the unemployment. The other really interesting data point is if over the last 3 years you normalized the unemployment rate for workforce participation, the actual unemployment rate right now will be 4.9%, which would be getting dangerously close, if not, that we would have way far cut rates at this point.
Yeah.
And so if inflation continues to temper, and we knew that there would be base effects this summer based off of the inflation numbers of last summer. So we knew that we would have a jump on the monthly and CPI headline this summer. We're working our way through that. If in September we see low inflation, jobs don't materially improve and unemployment potentially even rises a little bit more, I think we're going to see 3 to 4 rate cuts, going into the end of the year.
Yeah. It's one of those very interesting, I mean, this is a core tenet of modern central banking, which is you have this division in between, fiscal and monetary authority. And yeah, I am personally a believer. I think that should remain intact. I could see Trump's logic here, right? Like, again, not a macro expert here by any means, but it seems like, hey, I want to even out some of the trade imbalances, generate some additional revenue for the US. I think that's probably going to stunt some growth. So to balance that out, I'd like rates to get lower, right? That's probably the look through that he's trying to get at here. So hey, one thing that I would love to get your take on, which is a little bit more returning this to a crypto pod, which is This is an executive order that Trump signed to ease the path for private assets in 401ks. So this was an executive order which was signed this afternoon. We're recording this on Thursday to order easing access to private equity, real estate, cryptocurrency, and other alternative investment assets in 401ks. So what he actually signed was an order to direct the Labor Department to reevaluate guidance around alternative asset investments in retirement plans, subject to the Employee Retirement Income Security Act of 1974. Yep. The full text of the order is not out, so we're still kind of guessing at what this exactly means, but it's pretty clear what Trump wants to happen here, right? Which is allowing for crypto, but also other things like real estate, private equity, whatever, to get either, depending on your frame of view or point of view, for retail to have access to those investments in a tax-free way, or if you were more cynical, to, stuff assets into a new buying funnel. So, yeah, what's your take on this?
Yeah, so I think so. ERISA is kind of the name of that act and bill and regulatory structure that limits what's able to go into otherwise managed products for 401ks or retirement accounts in particular. And what that typically pertains to. So I don't know if anybody has actually tried to do a self-directed IRA. It's actually a very difficult process. You to be able to invest your own capital in a retirement account it's very difficult. You have to basically set up new entities and get new accounts everywhere. And whereas the vast majority of retirement capital is actually managed. And that means it's either in a target retirement product, like one of the Vanguard products, or it's managed by a pension manager, or it's managed by maybe the company account, depending on the structure. So all this is to say, for the managed accounts, people who are managers of retirement money have to abide by the ERISA requirements. And so it basically says like you can and cannot do certain things. And the idea is, well, we don't want people investing in risky things. This is supposed to be the money that they're going to live on once they stop working. And on the flip side of that, you have massive appreciation of capital in both the private equity market over the last few decades, obviously the crypto market, but also the real estate market. And if you are only able to participate in, let's say, the S&P 500 or fixed income assets, it really does limit not only the capabilities, what yield you can generate as a manager or as an owner of one of those retirement accounts, but you also are limited in terms of the diversification potential that you get from having these as important elements of what would be considered a diversified portfolio. And maybe we're a little bit crypto heavy on our perspectives here, but the Matt Hogan or the Bitwise perspective is that it's actually beneficial because it reduces volatility and increases return when you add something like crypto or Bitcoin to a portfolio that's diversified. And so I think, and the same effect happens when you're, real estate, let's not say it isn't like, oh, I want to buy my house with my 401k. It's more like I want to invest in REITs that have a diversified approach and a yield element to them. And maybe they're going off and actually investing in AI data centers, and you're getting a flow of those cash flows. But with private equity, it's the same thing. I want to be able to invest in a fund that invests in private equity funds and gets me, 15, 16, 17% IRR in a diversified manner because it's across many funds, which is across many, many companies. And so I think there is the positive and the negative take on this, which is this is just, opening up these capital markets to much more capital, and people are going to get hurt. I don't think that that's the case, because the managers of these of these accounts, of these portfolios, are still in thinking in terms of diversification. It's just like now they have more tools to use. It doesn't mean that they're guaranteed to employ them or add them to the mix. But if you're trying to get as much yield for your clients, or in as a diversified and therefore risk adjusted manner, you should absolutely have access to all of these tools. So I think ultimately this is a really positive thing, not just as someone who wants to see more capital flow into crypto, because I think it benefits people. But I think it's something that's positive for anyone who has a 401k that's managed and you don't have control over it. And you have to trust that that person is doing the best that they possibly can, because now they have more tools. Now they have more capabilities to add to the mix.
So it's giving people more choice, basically, is that. Yeah, I think one philosophical question that I find a little bit difficult to fully answer, because people approach it from such an ideological perspective, is how paternalistic or much of a nanny state do we want involved in our finances? And my reaction I think we're too far in one direction to skip to the end, of my opinion here, where we're too prescriptive around what we allow people to invest in. However, I do understand why that exists, right? Like, let's just take it from a problem. It's easy when you're very far away from an issue to just approach it from an ideological perspective. You're like, I like freedom of choice, therefore I like this. It's like, okay, but if you have a problem, which is people are idiots about how they invest their money, and you have the citizens of your country, YOLOing into dumb stuff and blowing their retirement accounts, that's a problem that you need to solve, right? So you have to find some amount of balance here. But I think that as a society, we've probably done two things, which is one, gotten too prescriptive and paternalistic about what are good and safe investments and not. And that's contributing to the wealth inequality in the US, which I would argue is still the most pressing problem that we need to solve as a nation. Right. And the other thing too, is it feels like our markets are overregulated, at least like public markets feel overregulated, right? Isn't it a massive problem that people want to stay private for 20, 30 years? I mean, shouldn't regulators be highly focused on fixing that?
Well, so a couple of thoughts there. The reason why that is the case is not because they want to stay private. It's because the threshold to come public as a company manager is so much higher, based off of this thing called Sarbanes-Oxley that happened in 2002, following the accounting scandals and the crash of Enron, WorldCom, and Arthur Andersen. And so the requirements to go public are now that much higher. I would actually make the argument that that's one of the reasons why crypto has become a feature, is because it fits in the middle of the stack of private, early stage, growth stage tech companies, massive publicly traded companies that are going public at $50 billion. There isn't really that middle ground, or that middle ground in the last 2 decades has been taken up by the growth equity investors. And so there's no public participation in that growth. And that's a problem in my mind. And so, once again, private equity can invest retirement account money. Well, maybe now they can actually get access to some of those growth products and be able to participate in that growth. But the other thing in terms of regulation, one of my favorite examples is when Apple Computer went public. I think it was 82.
I know exactly what you're about to say, but continue.
The state of Massachusetts prohibited residents of Massachusetts from trading in the stock, I think for a few years, because it was thought to be too volatile and too nascent of a company, and therefore too risky of an investment. Imagine, you own an Apple computer and you're an Apple fanboy. You love Steve Jobs, and you're like, great. I know this company so well because I am the quintessential, fanboy of, Apple gadget guy, and you can't even touch the stock because your government says it's too risky for you. But if you live in any other state, you're totally fine. Like that, I think is obviously overregulation. But it does feel like we kind of breach on some of those grounds with some, I would say, misguided perspectives. And, this definitely came over the last couple of years in the crypto space with the SEC. It's like, hey, you can't use this product if you're in the US. It's like, I just want to airdrop farm and get free tokens. Like that I think, we've definitely lost out on money. But yeah, this is, Apple
this is great. Apple Computer is set to go public today. Massachusetts bars sale of stock as risky.
Too risky. All right.
You know what else is just crazy when you think about it is, Apple, even it was pretty hypey stock at the time. Steve Jobs was still a known entity even at that point in his life. They made less than 100 million by selling stock.
Oh, do you know the market cap of Amazon when it went public?
I don't.
300 million.
Actually, you know what? I was listening to Michael Dell the other day. He was 150 million when it went public.
So once again, that where it remove equity, remove token, remove market, whatever. It's like, where do you see high growth opportunities that are trading or launching at hundreds of millions of market cap or market value, the only place right now is crypto.
Okay, here's another. What about the other reason that people cite, which is, okay, you actually have very successful private companies which could clear the bar of becoming public companies, but they're deciding not to, right? OpenAI, SpaceX, Stripe, these would be examples of companies that have stayed private, could be public, but they're like, you know what? I don't want to deal with the short-termism of public markets.
Yeah. There's an argument there as well where, look, it definitely is hard to find, and you have to have an income threshold that gets you there. But if you want to buy in any of those three companies, you can.
Yeah.
There are secondary offerings where you can get access to it through a bank or a financial manager, someone, and maybe OpenAI is harder to find than the other two, but the other two are very easy to find, and there are platforms even that support this. And so I think it's not. Obviously, that doesn't democratize it down to a level that is fair. And so that I think is, maybe some of the efforts that Robinhood and what they announced in Cannes a few weeks ago is something that they will help enable, which is tokenized access to, basically an ADR that tracks these stocks. But why would you go public when you are beholden to a conference call with, hedge fund, Wall Street investors every 3 months? They think in terms of 3 months, whereas you, as the founder of the firm, maybe think in decades or multi-year horizons for everything you're doing. You want to take bets and make experiments, but you can't because they'll hold your feet over the fire in doing so. And so I see both sides, I guess, which is like the short-termism of what that publicly traded rigmarole is every 3 months is real. That being said, I think that there's a lot of credit that you get for going out and getting public. And if you can raise capital in the private markets like they've been able to, that's great. But what they're not able to do is access debt markets. And so accessing debt markets would be a much better accretive way of accessing capital. And so I still don't understand why it's the balance of go public, clean things up, get things in order, and start the process of reporting every 3 months to be able to access debt markets or cheaper costs of capital versus very expensive private capital.
Shout out to today's sponsor, Katana. Katana is a DeFi-first chain built for deep liquidity and high yield. No empty emissions, just real yield and sequencer fees routed back to DeFi users. Incubated by Polygon Labs and GSR, Katana is launching with notable ecosystem of primitives, assets, and partners like Morpho, Chainlink, and more. Katana's 1 billion KAT campaign is live. Bridge and deposit directly into vaults in one simple click and start earning immediately on your Ether, Bitcoin, USDC, and more. Follow the link in today's show notes to get started. EigenLayer is ushering in crypto's cloud era with the launch of EigenCloud. EigenCloud is a full developer platform that gives developers cloud-grade programmability with crypto-grade verifiability on any chain. EigenCloud's use cases don't stop at crypto. AI's rapid growth is reshaping how we live, work, and connect, which has simultaneously made it today's most important and least trustworthy technology. EigenCloud has arrived just in time to enable verifiable AI infrastructure with crypto economic guarantees, where incorrect behavior gets financially slashed. This isn't about picking winning apps or chains. With Eigen, stakers can own the fundamental building blocks of the verifiable cloud. Every application built on EigenCloud draws security from staked Eigen tokens. Every crypto economic guarantee is backstopped by slashable staked Eigen. To learn more about how the Eigen token is securing a new class of verifiable apps and how to get exposure to this growing class of crypto infrastructure, follow them on X at EigenLayer. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
All right, let's change topics here. Talk about our resident hype man, Tom Lee, who is, come out of the nosebleeds just swinging. I mean, I always knew who Tom Lee was. I've been following Fundstrat for a long time. He's been very right, done very well. People talk about him as kind of being a permabull, but he took up the cause of Ethereum at a super interesting time when sentiment was in the gutter. ETH BTC has been bleeding, and man, he has turned it around. And I think he's teaching people in crypto, old bag holders of ETH, had a dream again. I mean, one really telling thing that's changed, since he came on the scene in a big way is even people were bullish on ETH, like maybe 5K, 6K by end of year. And he's just come out. The reason we're talking about him today is he came out and was like 16K. I think we're having our, 2017 moment. And I think ETH still has 100x potential from here. And you need people setting those high price targets, right? So you can be like, okay, it might not be 100x, but maybe it's 20x.
The coming out of the nosebleeds, I don't know, is the most fair way of putting it. What I would describe it as is it's like your current pitcher, in the last year, you realize he's got to go sit down. You got to call the bullpen. And out from left field, you see Tom Lee running towards the mound. But it's the equivalent of Mariano Rivera running onto that mound for you.
You've lost me. I'm not for the sports. You're
I'm
following you in theory, though. Yeah,
the best reliever in the history of baseball. But he, I think, has. He's a mainstay on CNBC. He goes on weekly or every couple of weeks. It looks like. Everybody wants his perspective on the general markets. He's been very pro Bitcoin for a long time. He's also been very pro Ethereum and broadly pro crypto. I think he's probably one of the first research shops with Fundstrat to really adopt a crypto native perspective where they're valuing it, they're talking about it, they're writing reports on it over the last decade. And I think, now that he is the chairman of BitMine, what he represents is a very credible participant in the ecosystem that puts him, on par with people like Joe Lubin. And it's crazy to say, but Tom Lee is the largest public owner of ETH, period. And that is only going to increase. He says he wants to get to 5%. Any day now or any week now, he's going to announce that he's crossed 1 million ETH tokens in BitMine. And I listened to the Bankless pod with him, and that's just like catnip for any ETH bull. But he's got really strong perspectives, really good arguments, and leaves a lot, frankly, like open-ended, because I think there's a lot of stuff happening beneath the surface that he can't talk about given his relationship with BitMine. So he is having a glow up moment for the crypto natives.
Yeah. And this is a ratio we haven't shown in a long time, but this is what everyone likes to see, which is the ETH BTC ratio, which really bottomed out, below 0.02. So 0.018. And it's just been, a rocket ship for the last 3 months or so. And I think that Bitcoin has still outperformed ETH on the year, but in terms of flows and price performance for the last 3 to 6 months, ETH is now crushing Bitcoin, which it's been a while since we've seen that, which is, what does it make you feel? Like, does it make you feel any type of way that what's driving the acquisition of all of this crypto, be it Bitcoin or ETH or whatever, is these treasury vehicles? Like, I'm not really sure. We did that podcast with Jeff. He actually, shout out Jeff. He joined ProCap with Anthony Pompliano as, I think, chief investment officer. So, well done, Jeff. But yeah, what do you make of it? The fact that that's why everyone's buying all this stuff. What do you think?
Well, so to maybe take a quick step back, I think and Tom Lee talked about this in the pod, but Wall Street has gotten around on the perspective that Bitcoin is digital gold. It's something that you can comp against gold. There's a generational perspective on it. It is, a store of value and should be viewed as digital gold in a lot of ways. Maybe with the call option potential of becoming like a tech or a monetary platform eventually. Whereas Ethereum is very clearly the place that Wall Street will want to tokenize assets. And as we start to see more post-Genius Act, and as we start to see more what we expect will be with Clarity tokenization efforts, it's all going to be tokenized, and it's very clear that Wall Street wants to tokenize on Ethereum. And so what is that worth? Well, it's worth a lot of value. And there's a great line that he also has in there where Ethereum is 10 years old and it has 0% downtime. That is a requirement for Wall Street. And so if you think about these in terms of what is the narrative perspective, well, digital gold on one end, tokenization on the other. And those are the two assets that matter. Frankly, right now, nothing else really does for Wall Street, because why are people, putting so much capital and looking at the different products of, all these different digital asset companies? It's because they have an implied leverage to them, to the crypto markets. And if the ETFs are buying spot and driving up spot, well, you're going to look at all these different other companies which have a positive MNAV and they've got the ability to raise debt, and they're going to continue to outpace just in the same way that strategy has outpaced Bitcoin over the last 3 years. And that, I think, and there's different ways of breaking it down where it's like the velocity of your MNAV based off of how much you're acquiring per share over what period of time. Then there's also the volume of your asset, which, or the volatility of your asset as well, which gives you the opportunity to have a robust options chain, which gives you leverage ETFs. If you have high volatility, then you have a better pricing mechanism for convertible debt. Like, the financial engineering that goes into these is pretty strong and interesting. And frankly, this is where, if I was to take a step back, I think the conversation with Jeff was great as it relates to Bitcoin. And, ProCap is going to be a Bitcoin entity, or a Bitcoin predominantly entity, where I could see these things getting really interesting. And this is what Tom Lee talks about as well. When you have the ability to earn a native yield with the asset, and let's say Ethereum's native yield is 3%, if you were to slap a 20x multiple on that yield, because it's basically 100% net income, if you're to put a 20x, even below the S&P 500 price to earnings on that, that implies an additional 0.6 of MNAV that is not capable with a Bitcoin product. And that, I think, is another advantage with some of these, as we get further and further out the curve. In Wall Street, it's simple-minded in a lot of ways, where it's like, okay, we finally understood the Bitcoin pitch and strategy, and like, great, Michael Saylor, he's won. Now we're moving on to things like Ethereum that have a native yield, they have a storyline, and so yeah, I would say I think we're kind of like, I don't know, inning 3 or 4 to go back to the baseball analogy, but there's gonna be a lot of game to play, and a lot of wonky stuff in a positive way will happen, but there's still a long way to go. And just in the Ethereum, last thought, there's 3 companies now, 2 or 3, I think at least 2, that want to both get to 5% ownership of Ethereum, and they're both at less than 1.
Yeah. You know what, dude? I've always loved that. I just think that yield is the driver. I think that people you can go back and find all these quotes from Jack Bogle, the founder of Vanguard. And the thing that I've always hated the strategy of like ultrasound money, because why would you try to compete with Bitcoin at its own game when Bitcoin has a ceiling on it, when the world isn't burning and yada yada, but people really like productive assets. Bitcoin is not a productive asset, and that's what ETH has always had going for it, and it's such a killer value proposition. So I think that that's going to really work, and yeah, I think ETH has completely won. I think ETH has basically won DeFi for the most part. Like, I don't really see any of these RW, like tokenization, maybe not DeFi as so far, but tokenization, like real world assets, everyone's moving on to Ethereum. You know who else is doing pretty well is Arbitrum at the moment. They've had some really big wins recently. I wanted to talk to you about Boros, which is this new Pendle, basically interest rate swap market for funding rates. But yeah, they had Arbitrum, or they had Robinhood builds on them. Yeah, I think. Anyway, I don't know. I don't have any super sophisticated thoughts here. It's clearly ETH's turn here, and it's going to run for.
Yeah, I think we're, to go back to the Tom Lee quote, 16K is his target. He's like, well, yeah, and the kind of amazing thing about his perspective too is like, and he calls this out. It's like, look, it's in my best interest if ETH just stays flat for the next 5 years and then rips. Like, I don't want it to, but this is what I think it's going to do.
Yeah.
And like, they're trying to acquire as much ETH as they can at these prices, because that's going to be the most beneficial for the equity that they own, which is Bitcoin. Like, I think we're about to see a lot of structural change, and price begets narrative begets price. People start talking about it. And then I think what we're also going to start to see, in particular with this like reverse tokenization effort broadly, digital asset treasury company broadly, is you're going to start to see, okay, ETH, all right, we got the winners there. Now what are we doing? Okay, now it's on to other assets. And maybe it's stuff like the Athena or DeFi native, treasury companies. And we start to move further and further. But this is how we basically like boil the water of Wall Street, with Wall Street being the frog. Is like we just start feeding them more and more stuff as they get deeper and deeper and deeper into this. And pretty soon they're like crypto natives.
Yeah. Okay. So I wanted to get your take on this. One thing that I think is there are two interesting categories I think to look at here. We talked about internet era companies like Amazon, and I think we've talked about on this show where it took Amazon 10 years to get back to its IPO price. There's a long dip, and I'm starting to wonder if that's roughly how you can think about DeFi today. If you look at a lot of these charts where, there was a crazy, mania and speculation around, the Aves and the Uniswaps of the world when they first debuted and went live. And to be clear, there are still big governance problems, I think, at a lot of these protocols and weird, conflicts, misaligned incentives, that type of stuff. But in the last couple of years, the charts don't look great, but they're starting to build back. In the meantime, they've built monster businesses with huge moats in some cases, and they're kind of just trucking along, and they might be really interesting bets here. And two catalysts is one, we're talking about, these ETH treasury companies. If they're going to put that money to work, they're going to put it to work in these DeFi protocols, right? Like that's where they're going to go to generate yield. Like the borrow lend protocols of the world, I think are kind of a no-brainer here. And the other thing too is, just all of these stable coins moving on chain. And, we talked about on previous episodes, checking accounts being a bit of a scam, right? Like why do I just hold my money in a checking account, get no yield for my bank to lever up my assets and get a huge net interest margin? And I want to read this tweet from, this is Nick Van Eck. Athena Labs kicked off a new era for what I think is going to be one of the continued largest and fastest growing segments of crypto native businesses. I'm still tinkering with the best way to articulate this segment. Yield coins, on-chain asset management, don't love any of them yet, but the product is yield. Athena did several things incredibly well. Bring yield on-chain in a yield-starved era, opening up access to a popular, profitable TradFi strategy in a crypto-driven manner, BTC ETH basis, superior form and function. The $1 denomination was key instead of doing it on a NAV slash PPS basis like typical funds, risk management and building trust. He mentioned Maple as another great firm to put in this category. We just did our interview with Sid last week, which also got me thinking about this. And I think that, when I think about, okay, what happens if Scott Besson is right and we get, $3 trillion worth of stable on chain? What's going to happen? I think that money's going to look for yield. And I think that these dollar denominated yielding products, I think there's going to be a massive wave of these companies that go out, bring, good kind of, somewhere in the neighborhood of like 10 to 15% yields on chain. And you're essentially going to blur the line in between checking and savings account where you bring your stable on chain. It just goes and sits in one of these yield bearing assets. And when you need to spend it, it immediately gets spent. That to me is like a big improvement. And I think, so anyway, that was a little bit of a ramble, but that's the huge driver that I see.
I mean, so to take it all the way back, we kind of talked about this with Sid too. Like there is that famous Carlota Perez technology cycles where you have like an initial boom that gets the capital to come in to invest to build the infrastructure layers. Then you have a bust, and then you have basically like the path to productivity. And I think we are on the tail end of that now, where 2020 or 2019, 2020, 2021 was the build out era of DeFi. And I mean, we get this question a lot. It's like, well, what are you guys investing in from our LPs? I mean, like we're investing in DeFi. It's like, well, wait, DeFi, I thought that was done in 2020. It's like, no, you don't even get it. Like we're just getting started. And I think that, bringing back the classics is kind of like where crypto is right now, which is it's a lot of the same stuff. It's a lot of dispersion where there's not going to be 25 different, borrow lend platforms. It's basically like there's a few that are winning massively, but the scale of the win is much, much larger than we could have ever even imagined in 2020. And so I think that's kind of like why this feels different, why this cycle feels different. It's institutional. It's kind of like winners are going to be much bigger, but there's going to be much, much fewer of them. And it's back to the same stuff that we were doing 4 years ago. And to talk about Athena in particular, I think where we are with that and yield coins, stable coins, I completely agree. Like the path here is stable coins come on chain. They are sitting idle in wallets. Well, why would you do that? You should go out and at least find some yield. And then they move into yield coins. Those yield coins get put into things like Athena, or they get put into Sky, or they get put into other yielding opportunities, on chain. And the blurred line starts to happen where it's like, well, wait, is this USDC or is this like USDC that was swapped for USDS and then is staked and now it's SUSDS, and then you're like, but it's earning 5%. And like, I think that there's like, we're at the levels of abstraction where it's still hard from a consumer perspective to see this. And I think we're also at a capital perspective now where a lot of the capital, frankly, is still just sloshing around internally. Like we haven't broken through into that, oh, we're getting billions of dollars or tens of billions of dollars coming on chain every single month. It's happening slowly, but it's not going direct into things. And even this week, Spark, which is built on top of Sky, saw that because the basis trade, the basis within Bitcoin and Ethereum is much lower than it has been over the last few months. USDE, which is the Athena product, is much lower on a staking rate, on a yielding rate than it has been. So Spark, which had allocated almost $1 billion into Athena, decided to pull that back, basically in one vote. They're like, oh, okay, Athena's got 9 or 10 billion of TVL and we're 10% of it. Like we're going to pull it. We're basically pulling one of the billion down and we're going to put it into our own other things because we need to go find new opportunities. And so it's not like everybody is just flush with, incoming cash. It's like, it's moving here and then it's coming back and then it's yield finding right now. But yes, like the narrative here is that yield is what is driving adoption and activity currently. But what frankly I am looking for and looking forward to is how do we bridge the gap of getting dollars into these yield opportunities with like robust flows. And truly, I do think like one of the mechanisms for doing that is going to be yield backed bonds issued by digital asset treasury companies. Where if, let's say the Athena treasury company, which I can't remember the name of it, but they've launched or they've announced the launch. If USDE is yielding whatever 5, 6, 7, 8, 9%, why not go off and just issue a bond that just passes 100% of the yield back to the bondholders, and you take the cash and put it in? Like that's more TVL. And so I think like there's going to be some really interesting productization here, and the like. I was describing this to Vance earlier. Like, I don't know if you remember from biology, but like the description and the visual of osmosis is like these little holes pop up on the side of the cell, and like that's how water moves in and out of a cell. Yeah. These little holes that allow for the transmission of water through a cell membrane are these digital asset treasury companies. It's like how we're going to bridge the gap.
You know what I hadn't even really thought of? It's a massive advantage for, if you're a crypto company like a protocol or a company like Athena, you really only have access to like VC funding or token funding sort of markets. And now you can tap public markets, you can tap fixed income markets. It's just a whole new source of funding and investors and buyers.
And it's not going to be something where like all that we've done so far is like, oh, let's go buy our own coin.
Right.
Buy our own token. No, like that's what if you own a bunch of, ENA in this company, but you want to go raise $10 billion in a bond, not even a convertible note, a bond that is backed by USDE and it's yielding 7%. And like the other thing that we haven't even talked about, which we talked about earlier, is like, and we're doing this at the start of a rate cutting cycle.
Yeah.
where credit spreads are about to increase. Like the attractiveness relative of these opportunities is going to only increase over the next few years relative to what you could get in a money market fund. And so I like that. That's why I think we're at the start of this, like, oh, DeFi is going to be massive and these winners are going to be massive, because it's not going to be like, cool, we like got added 100 million of TVL today. It's like, oh, we added 10 billion this week.
Yeah. Damn, Michael. That's a good pump up speech. I agree, dude. I think the osmosis is a good analogy too. Yeah. So maybe these maybe what happened there. But yeah, maybe these treasury like these DATs or whatever, their treasury vehicles. We just need a little bit of time to experiment. More interesting mechanisms there. And one other thing too, which maybe just like a side shout out here, but I think that, you mentioned all of these rates are variable in DeFi still.
Right.
If you remember back to the origination of the Blockworks framework relationship, but the first bell curve season when Jason and I were hosting this podcast together was the importance of fixed borrow lend in DeFi. And it took forever to get there. But I think we're finally, like, Morpho V2 is going to have that built in. Boros is an interesting way to basically for you to trade. It's like an interest rate swap for funding rates. So if you're, using perps, like, you don't have to take that interest rate risk essentially. And yeah, I mean, it makes sense that you would do that for basis trades too. So yeah, I think that outside of even just capital moving in, you'll have all these interesting new exchanges and sort of side businesses to package these yields in interesting ways to investors, allow them to hedge. Actually, Pendle's pretty interesting. Again, nothing is ever financial advice for me, but Pendle's not looking bad here. And I'm happy that they didn't try to launch a second token or do some kind of weird shenanigans like that. They just, built another revenue stream and had that value accrue to the token. Like, what a concept. But they've just been chugging along. They're doing well.
Exactly. I think that that's the right form of alignment at this point. And yeah, I completely agree. Like, a primitive that isn't as widely solved yet is fixed rate, and fixed rate as well as fixed term, which I think is another kind of implied with fixed rate. But being able to say, like, hey, here's $100 million. I'm going to give you that for 8% for the next 12 months. Like that is and being able to pull that off chain and do whatever you need to do, like that I think will open up capital markets in a pretty significant way, because you can start to go off and once again productize different products that Wall Street would be expecting to see, and put them in an equity wrapper.
Yeah. All right, Michael, what did we miss? Anything else, or how are we doing? I think that's pretty much it.
Exciting times. Hopefully everybody's getting out, getting some sun.
Yeah.
Yeah, it's going to be a fun fall, but rest up for the rest of summer.
Rest up. Yeah. The sell in May and go away was not actually actually you did okay. Yeah.
It depends on when in May, but yes.
I was just thinking back. Yeah. All right, partner. I will catch you next week. Cheers.
Yeah.